Hi, today's topic is Get More Back Than You Give. Opportunities in the 2020 CARES Act, a few Secure Act solutions, and other tax saving ideas. My name is Victor Lloyd Burgess. I'm a financial educator, a lecturer, and an author. I'm in the San Jose, California Bay Area. This is our legal disclaimer for the presentation. This presentation has several educational examples of what basic tax scenarios may look like and should not be construed as presenting any tax outcomes. No other incomes or parameters, which could alter the outcomes, have been considered. They are only to illustrate how a charitable tax deduction could be applied. The various dollar amount values used in the illustrations are examples. Your values will be different and based on your particular situation and illustrated in your quote. Always consult your tax professional for your situation. Now, what are most of us looking for when it comes to our long-term investing? What is it that most of us are seeking? Good, steady growth. I think most people will agree with that. As long as you have good, steady growth long-term, we're going to be a winner. Now, what is the best way to maximize that growth? Saving more of your income is one, so you can put more into it. What is the best way to do that? Minimize taxes on your income. Defer taxes on your income. These are the two most popular ways to be able to put more into your investing. What is the best way to make your money last in retirement? Once you get there, you've invested and built your nest egg, and now you're going to use it. Tax-advantaged income strategies for your withdrawals. That's good. Tax-free income for your withdrawals. That's even better. And lifetime income, especially if it's tax-free, that's even the best. Now, there are many ways to give to charity. This way works for you and the charity. It's called a win-win. Now, in 2020, you can get 40% more tax deductions. The 2020 CARES Act increased charitable deductions from 60% of AGI to 100%. However, only till the end of 2020. A tax deduction of 100% of AGI equals what? Zero taxes. Now, how does this apply to you? You can use that to lower your tax bill this year, use tax deductions to lower your tax brackets, create more retirement income when other options are maxed out. Now, later in this, we're going to talk about a case study showing how a high-income earner used $250,000 of excess income to purchase a charitable plan that gave $130,000 in tax deduction, $24,000 in tax savings, and a retirement nest egg of $354,000, totaling over $485,000 in benefits, and they were able to help a charity. Now, they can repeat this every year. This is what you call get back more than you give. It's a win-win-win. It's a win for you, it's a win for your charity, and it's a win for your retirement. There have also been some changes to the way you take distributions from your 401ks and IRAs. If you're under the age of 59 and a half, you can withdraw up to $100,000 from your IRA during 2020 without the 10% penalty. If you're an account owner, you must have either yourself, your spouse, or a dependent was diagnosed with COVID-19 to qualify, or if you had to have some, as an account owner, you had to have some adverse financial consequences as a result of the shutdowns, like a quarantine, furloughed, laid off, having work hours reduced because of the virus, or being unable to work due to lack of childcare because of the virus, and or reducing business hours due to the virus. The other thing they did is they waived the 20% mandatory federal income tax withholding when you make a withdrawal in 2020. It's still taxable, and you have 3 years to pay it back or return the money and call it even Steven. Now for a little background on myself. After leaving the United States Navy, NAS North Island, San Diego, California in 1982, I moved to the San Jose Bay Area, where I worked in the semiconductor business for 20 years. In 2000 and 2002, the market had a terrible crash. I saw colleagues and friends suffering up to minus 48% losses in their retirement plans, and I thought to myself, there's got to be a better way. Well, I've been developing and presenting educational workshops, helping Bay Area families since 2002. Before leaving the securities world, I worked for several broker-dealers as a securities representative and held the Series 7, 6, 63, and 65 securities licenses. I then gave those up and kept my California license because I wanted to specialize in tax-free and guaranteed lifetime income strategies. As a San Jose author, I've written many educational seminars for seniors around the San Jose Bay Area. I wrote a Do-It-Yourself Financial Planning and a Power of Self-Directed IRAs course. I wrote a book called Let's Cut the Crap, later changed to Straight Talk, a financial guide for no-nonsense people. I created the Endless Money Stream strategies, which provide lifetime multiple income strategies. I wrote a True Love book. Now Volume 3 is out, a relationship guide and workbook. And I'm working on a novel called Equilibrium, an action-based novel currently in the works. I am a U.S. veteran, served on USS Kitty Hawk 63. This is a picture of the USS Kitty Hawk CV-63, which I served on. Flight deck area was about the size of 4 football fields, 5,500 men on board, 80,000 tons in the water. I was with the OE Electronics Division. I served from 1977 to 78 when we did a West Pacific cruise, and a West Pacific cruise in 1979 to 1980. If you recall, at that time, November 4th, 1979, we had a diplomatic standoff between the United States and Iran. 52 American diplomats and citizens were held hostage for 444 days. Now here's how to use a charitable foundation for a win-win-win strategy. You donate an asset to a charitable foundation, 501c3. The foundation then issues a charitable plan contract back to you. They obtain a reinsurance contract, highly rated insurance company, to pay an income to you or issue grant payments to a charity or a combination of both, depending on what you want to set up. Now there are 2 types of charitable plans. A partial tax deduction return of income. That's a charitable sale with an installment contract. Now that's term certain income. Let's say 10 years, 15 years, 20 years, like that. The charitable gift, which is based on 1 or 2 lives, that supplies a lifetime income. Now this currently is not allowed in California. 100% tax deduction grants to charities. Now this is a fixed grant payments to a favorite recommended charity that you choose. It's under a donor advised fund. Now both types may be funded with assets other than cash. You may have annuities, securities, or real estate that you don't want to pay taxes on, and this would be an opportunity for that. Now let's talk about a partial donation return of income. Donation here is $100,000 to a charitable foundation which issues a charitable plan. First part of the charitable plan is immediate or deferred $100,000 or more for income. Now again, it's immediate or deferred, lifetime or period certain, other than in California, where you don't have the opportunity to use a lifetime income. They can use this for themselves or their heirs, and they can also use it to fund an insurance policy to replace that asset value as a death benefit. The second part of this plan is a charitable income tax deduction of $40,000. The income tax deduction can be used to reduce your current income taxes for anyone who itemizes, or move to a lower tax bracket, reduce capital gains when applicable, access qualified funds tax-free, reduce your RMDs, execute ROTH conversions. You also on the third part of it are funding the charities that the grant person has chosen. So whatever whatever charity you want to do it, it's going to get their immediate grants. Now let's look at 100% donation grants to charities. Again, donation, $100,000 to a charitable foundation. Charitable foundation issues a $100,000 charitable plan with a $100,000 tax deduction. That tax deduction, same year tax deduction, comes right off your AGI, fixed annual grants paid to recommended charities. And payments are reinsured, and charity choices may be changed. Options for 2020 Secure Act. The Secure Act has several provisions that impact distribution rules for IRAs. Starting in 2020, IRAs passing to certain non-spousal beneficiaries must be distributed by end of the 10th year following the owner's death. The focus here is on the partial elimination of the stretch IRA with two possible options: qualified IRA to Roth and qualified IRA to life insurance. Now, under qualified IRA to the Roth, create an income tax deduction by funding an 8-year deferred 20-year certain plan using non-qualified funds. Convert the IRA to a Roth and use the new charitable plan deduction to offset the taxable event of converting that Roth. Under the qualified IRA plan to life insurance, we're going to liquidate the qualified assets, retain funds to offset the taxes of that liquidation, use the remainder of the fund for an immediate 20-year term plan, and use the plan as a tax deduction and retain funds to offset the taxable event. Use the immediate income from the charitable plan to fund a life insurance product. Okay, now we're going to look and see how a charitable plan offsets the taxable event of doing a Roth conversion from a traditional IRA. In this example, we have a $500,000 IRA that is going to be converted to a Roth. That conversion, based on the 2020 marginal tax rate of 23%, is going to create a taxable event of about $115,000. We're going to be setting up a charitable plan using non-qualified assets. That's step number one, create a charitable plan. The charitable plan is going to use $1 million in our example of non-qualified assets. The charitable plan is going to provide a $500,000 income tax deduction. We're going to be able to use that income tax deduction of $500,000 to pay or to deduct the $115,000 from the Roth conversion. So $500,000 of tax deduction minus $115,000. That's going to leave $384,000 to take care of any taxable consequences of liquidating the $1 million assets for the charitable plan. So the charitable plan's $500,000 deductor is covering the Roth conversion, $115,000. It's also covering any tax consequences of the $1 million for the charity plan. So at the end of the day, we owe nothing. 0, 0, 0. The plan is also providing us $62,400 a year for 20 years certain. In 20 years, that means it's going to pay back $1.2 million for $448,000. The $500,000 IRA is now a $500,000 Roth IRA. The death benefit is, of course, tax-free as well as the Roth. So now you have a tax-free $500,000. And is the charitable plan start date here we have it deferred for 8 years, so it says we started at 8 years. Is that is this 8 years variable? Yes, it is. It is variable. The longer you wait, the greater the income. The earlier you start, the less the income. So if you start before the 8 years, it's going to be less income because it's growing over this 8-year period. If you wait till after the 8 years period, the longer you wait, the more it's growing, and the more it's going to give out here. Does it make sense? Okay, is the charitable plan fully insured? Yes, it is. Can the client make grant recommendations? Yes, you can. So, to sum things up, if you do nothing at all and you pass away today, what are the consequences of that? Well, you have a $500,000 IRA that will pass to your beneficiaries 100% taxable. You have $1 million appreciated assets that will also pass to them by whatever means you currently have set up. But what if you don't pass away until after you set up this plan? Then you pass away. Well, the $500,000 IRA will become a $500,000 Roth IRA, tax-free death benefit as well. You have $1 million charity plan paying grants to your charity. You also have the charity plan paying payments to your beneficiaries at $62,000 a year, $1.2 million over 20 years. Now, after you execute this plan, what happens if you live? Well, if you live, you have a $500,000 Roth IRA that's tax-free. You have no RMDs, no required minimum distributions. You have a $1 million charity that's paying grants to your charity of your choosing. You have a charity retirement plan that's going to be paying you $62,000 a year and $1.2 million over 20 years, 20 years certain. What can happen if you don't do this plan in 2020? Well, you can't get 100% of the AGI paid off. You may pass away, and you may become incapacitated, in which case you won't be able to do or change anything. Okay, now we're going to look at changing an IRA to a life insurance product. On the first step, we're going to liquidate the qualified asset. In this case, it's a $500,000 IRA, which is going to cause a $500,000 taxable event to our adjusted gross income. Now, according to the 2020 marginal tax rate table, 23%, that taxable event of $500,000 is going to come out to about $115,000. The $500,000 taxable event in step 2 says retain some funds. So we're going to retain $70,000 out of the $500,000 cash. So $500,000 minus 70 leaves the $430 to fund a charitable plan. The charitable plan is also going to produce a tax deduction for us. That $500,000 taxable event is now going to have a deduction of $173,000, which leaves $326,000. So we have the $115,000 we had here has been reduced now down to $66. We then take the $70,000 that we had retained earlier, and we're going to apply it to the $66,000. So $66,000 minus 70 This leaves us a plus 3,408. We also have the charitable plan paying $20,000 a year for 20 years certain. Over a 20-year period, that's $565,000. The charitable plan is fully insured, and you can change grants. Now let's take a look at where this leaves us. If you do nothing and pass away today, you're going to have a $500,000 IRA that is past 100% taxable. But if you don't pass away until after you do this plan, you're going to have no IRA. It's paying the charity in the form of a grant. The life insurance policy is replacing your IRA with a death benefit, tax-free, of $565,000. Now, after you execute this plan, what happens if you live? Life insurance premiums paid for 20 years. Those life insurance premiums is going to buy a life insurance product with a death benefit that's tax-free, and you might even add a long-term care rider on there. Tax refund of $3,400 instead of a tax bill of $115,000. But what if you were to pass away and you didn't do anything in 2020? Well, you can't get 100% of your AGI deducted. You may pass away, and you may become incapacitated, in which case you won't be able to do any or change anything. Prior to the CARES Act, an individual deduction for cash contributions to public charities generally was limited to about 60% of the individual's AGI. The Act increases the deduction amount during 2020 calendar year only to 100% of the AGI. How does this apply to you? Well, you can use more tax deductions in 2020. It's about 40% more. Create a charitable plan in 2020 only for 100% of the AIG reduction. Apply a larger portion of the deduction in 2020. Use the tax savings to save on taxes this year and access qualified funds and use tax deductions to offset the taxable event, such as things like a ROTH conversion, for example. Here's another short case study. Client has a adjusted gross income of $145,000. $70,000 is from his current income. $75,000 is through a qualified IRA, and he has $400,000 of various non-qualified assets. So in step one, the client transfers the $400,000 of assets over to a charitable foundation, who then give him back a charitable plan. Now, this particular charitable plan is giving him a tax deduction of $145,000, and then a non-deductible present value of future income. This will be when you want to use this in the future to come back at you. The sooner you take it, the less you get back. The later you take it, the more it's able to grow. Just like we were talking about before. Now, on step two, the plan normally, if with a $400,000 charitable plan, usually gives back more than $400,000 at the end of the game. This one here, you have the option of a $75,000 IRA deduction that's tax-free, or you can convert that part of an IRA to a tax-free ROTH IRA. So $70,000 current income plus $75,000 qualified event, which is either taking the money or converting it to a Roth. Having a $145,000 tax deduction leaves a new taxable income of 0. So the results: 0 reportable income for 2020, $75,000 available, or a Roth IRA, which is again also available tax-free, and you have a $400,000 charitable plan providing future income. Now previously, 2019, it was 60% of the adjusted gross income could be written off due to your charitable donation. This allowed for a deduction of $145,000 times 60% is $87,000. $58,000 taxable, that's 40% of your AGI. $87,000 deductible, which leaves $48,000 carry over to the next years for 5 years. In 2020, it's 100% of AIG. The $140,000 that the $400,000 buys, you can do up to 100% of your AGI, so you can use the full $100,000. So 0% is taxable. You get the $145,000 as your tax deduction, and you're carrying forward the $78 here. That's your carry forward that can carry into the next year, or it's carried for up to 5 years. So instead of the $87,000, you have $140,000, but only in 2020. So some other tax saving opportunities in 2020. Use more of a tax deduction in 2020. Lower your tax bill. Use tax deductions to lower your tax bracket. Create more retirement income when other options are maxed out. And you can even set up a structured inheritance for spendthrift heirs. So now let's look at that case study I talked about at the beginning of this program. Use more taxes in 2020. Let's say Greg, age 45, owns a construction company. Because of recent weather disasters, his business has significantly increased, which in turn has boosted his revenue. This presented new challenges. He needed to reduce his reportable income, and he wanted to put more funds aside to be used in his retirement. So let's see what Greg does. He takes $250,000 of extra cash that he's increased in his business, and he gives it to a charitable foundation, who then in return gives him a charitable plan contract. Of course, this helps fund some charities, if his choice or the charitable foundation. They then obtain reinsurance from a highly rated insurance company, and which pays him his income payments, and they're usually made directly from the insurance company on behalf of the 501c. What does he get in the plan? Charitable tax deduction of $130,000 and a savings of about $24,000. Now, he uses this to reduce his current year's reportable income, which he wanted to do. He uses it to potentially keep reported income below a tax bracket, which puts him in a nicer place, and offers another option to provide tax-favored retirement income. Now, the second part here, because he had a 10-year income plan from the charitable plan, is 10-year deferred. You can have it deferred anytime you want. Deferred 15 years. It's going to pay out $23,000 a year, and over that 15-year period, $354,960. So the income is tax deferred. Greg or his beneficiaries can access the income on the date of their retirement each year they wait. It gets larger, or if they take it sooner if they want to, it'll just get lower. Greg may set up a structured inheritance for his heirs as well. So his total income and tax savings for that $250,000 is $379,291. And he can repeat this every year. every year, building his retirement, reducing his taxes for each year, putting that money, packing it away. Now let's see how that looks on a tax bracket, margarine tax bracket table. Greg, in 2020, married, filing joint tax filing, $250,000 taxable income with no tax deduction, and 2020 standard deduction. The table for 2020 for joint, for married looks like this, joint filing. And his tax bill, $250,000 taxable income with no income tax. The deduction for 2020 is $24,800. That leaves his AGI at $225,200. Now this is not counting any other things that's going on with his taxes. We're only going to look at specifically the implications when he bought the charitable plan. So this puts him at a tax bracket here from $179,000 to $326,600. That's where his $225,000 falls. So you can see each year the first $19,000 is taxed at 10%. So his taxable amount and his tax paid from $19,000 to $80,000 is at 12%. So $60,000. The next $60,000 is taxed at 12%. So that's $7,000. And then from $80,000 to $171,000, it's taxed at 22%. That's $90,000. The next $90,000. So this tax on that one's 19. This is why we call it a progressive tax. It's $19,976. And then his final money left after the $90,000 was $54,000, and that's at 24%. So 24% times 54 is at $12,960. So you total that column up, that comes out to $42,000 as his taxable income, his taxes he owes. This is his taxable income here. This is the taxes he owes. Now we look at 2020. Same thing. Greg's married in 2020, filing joint, $250,000 income, but this time he has a $130,000 charitable deduction. Okay, so using the same table, this table and this table is exactly the same. The difference here is that is now has a taxable assumption tax deduction of $130,473. He's itemizing, so he didn't have the 24 standardized deduction because it's one or the other here. And you take that $130,000 out of his 250, it leaves 119. So now he's falling between 80 and 171. So now he's changed the tax bracket from 24 to 22 here, right? 24 to 22. So his first 19 still same 10%, same 10%, same tax. His 12% still 650, which is 650 here, same tax. But here now he only has $39,000 left that's taxable, so that drops him to $8,000. And if you total that up, you're talking about $17,000 versus $42,000, which means he's now has a tax savings of $24,000. Now I know that was a lot in a short amount of time, but what you've seen here is unbelievable, and I think most people will agree on that. The public charity that we use, the Charitable Foundation, has been was established in 1999, so it's been around 21 years. Now they're a spiritual, physical, and humanitarian aid 301c Charitable Foundation. And their primary charities that they donate to, if you don't want to pick your own, you can just choose to use theirs, is feeding the hungry, providing for an orphanage in Haiti, providing microfinance in third world countries to help people start their own businesses, to help people that were incarcerated to become more productive citizens after they're released, prevention of human slavery and sex trafficking, and helping young females deal with unplanned pregnancies, drug abuse, and emotional disorders. Of course, you can always pick your own charity, like medical research, children's health issues, wounded soldiers, colleges, churches, synagogues, disaster relief, local fire departments, schools, animal shelters, teen pregnancy centers, etc., etc., etc. The list is endless as long as it's a 501c. Donors help others by helping themselves. It's a win-win-win for 2020 win. Okay, you win in 2020 because you got 40% more tax write-off. You win on your taxes because you reduce your taxes in 2020. You win on your retirement planning because you're putting money forward in your retirement plan. It's just a win-win-win-win-win all the way around. Now, I know there's a lot of people when they hear this, they really want to look into it. There's no obligation to look into it. All we need to do is get together and move forward and get a quote so you can see everything in ahead before making any decisions of moving forward. Now, getting a quote for your information is going to be based on your unique situation. So, of course, I have to have information. Has this process been good for you so far? And what would happen if you would wait to do this? What could possibly happen? Just think about that a minute. You just learned a bunch of fantastic stuff. And if you just did nothing, what could happen? Okay. Is it worth your time to do this now? Think about it. This doesn't take a lot of time. I do all the work for you. After I get the documents, it's at least 2 to 3 working days for a quote. Okay, so you have something to look at, something to do based on your information that you give me. Then we, you and me, any attorney or accountant or anyone else you want, go over the quote. Then you can make your final decision to move forward or not. You're not under any obligation. You're not locked into anything. So to get your quote, all I need is 2 dates. One date is to get a copy of any needed documents that you may need depending on your situation after we've talked, and to meet and go over your quote with the people you want to go over it with, whoever they may be. Now, we can do this online or offline, okay? And it's real simple stuff, basic stuff moving forward. Getting a quote from your information, we're basically looking at, do you want to support the mission of the charity company, the mission statement that I just said, or do you want to recommend your own? And I put any notes or objective here for your charity. That's real simple and straightforward. The other one is looking at what assets you're planning to use. Are you going to use cash? Are you going to use money markets or CDs? Are you going to use an IRA? Are you thinking about it? Or some non-qualified money? Or some other kind of qualified money? We just make a note of that. Or is it going to be securities? How many shares? What's the estimated value? So they can do some, see what your tax consequences are going to be. Or is it going to maybe be real estate? Estimated market value, mortgage balance if you owe anything, cost basis, age of the market. Again, we have to know what your tax consequences are probably going to be. And if you have any depreciation on your property, is it straight line? Is it accelerated? The type of property, if you're using it, single family, multifamily, or is it land? Is it commercial or rental? Simple stuff. And if you're going to be using annuity maybe you don't think you're going to use anymore and you want to transfer it or change it or whatever you're going to do. The annuity company's name, the accumulation value, the cost basis, the surrender value, and the issue date. Real simple stuff, because whichever one of these you're going to use, we don't mark all of them, just which ones you have in mind of probably using to move forward. Of course, it's the charitable advisor is myself, Victor Lloyd Burgess, California. We'll put the date here. If there's a husband and wife, a spouse of any kind, or a couple of any kind, then the 2 people go here. Of course, I work in California, so you have to be in California for me to work with you. Your date of births, gross annual income, total net worth, liquid assets, adjusted gross income, tax rate table, that just like the tax rate table we're just looking at, your living expenses per month, how much does it cost you to live, what's your bills for a month. You can't use the 1 or 2 life charity plan in California, but we use the term certain plan. So how many years are you talking about paying it? 10 years, 15 years, 20 years. The delay time is variable. The desired frequency of the payments you want. Do you want them monthly? You want them annually, or what? A desired payment to begin. When do you want to start? Immediately, or you want to defer it? How many years do you want to defer it? Okay. Do you want to receive income during your lifetime, or do you wish to receive pass income off to your heirs, or do you want to do a bit of both? just simple questions, not a whole lot of personal information. So getting a quote, your information. So to get your quote, I need 2 dates to get a copy of your needed documents and to meet when it's over. And that's pretty much it. So hit the button. You can go to my. And I want to thank you for attending. Again, my name is Victor Lloyd Burgess. I'm in the San Jose, California area. You can contact me via email, victor@vlbusa.com. You can schedule a time at any time through calendly.com, vburgess. You can schedule time in the office, time over the phone, time on Join Me account on the internet. Or you can call me, 408-258-1042. Very easy to get a hold of. Very easy to get this process started. It's not a problem at all. Hit the button. It'll take you to my calendly.com, and you can schedule from there. It makes it really simple. Or like I said, just give me a call or send me an email. I look forward to meeting with you. This is something that's really unique and really fantastic. And again, the 100% is only for 2020. After 2020, it goes back to 60.